Good morning, ladies and gentlemen, and welcome to the show on this Wednesday, the 7th of July, 2021. Thank you for tuning in. Listen, I'm glad to have you guys here. First thing is, we want to get the chart started right here. There's a tropical storm going to hit Florida. Floridians are preparing for it, but it reached borderline hurricane strength there yesterday. Right now it has sustained winds of 65 miles an hour, and here's a storm, and it's moving in, and you can see where it's going to move in up around the Panhandle. It looks like it's going to follow the coast up to around the Panhandle. And there's another thing I want to talk about this morning. The hurricane that's coming in right now on the east side of this is awful early for a hurricane. This is just the beginning of the hurricane season, and already they're up to E in the lettering. A, B, C, D, E. I mean, this is unreasonably early for the hurricane. And that heat wave we had was extremely early in the year, too. Something's not right about the weather. The weather's off, it's almost like, what happened? Did our planet tilt or something? Why are we getting these weather phenomenons that should occur late summer or midsummer, rather than so early in the season? Anyway, I want to talk about the financial out right now, the crash. An awful lot of you guys probably asking, well, why are we going to have a crash? Why? What would be the cause of a crash? The markets are going up, everything looks good and everything. I'll explain to you why. We were not a complete command economy. We were not a complete command economy up until COVID crisis. And what I mean by that is the markets were not completely controlled. They were semi-controlled. COVID come along, and now we've become a command economy. In fact, every big economy, large economy on earth now is a command economy. And what does that mean? You're probably asking the question, what does it mean, a command economy? It means that the central banks are looked to as the only and sole support for the entire economy, and they command the economy. They control what the economy is going to do, is the central banks. And the whole world now has become a command economy. The problem with this is, if the central bank is what you're relying upon for support of your entire economy, and the central bank stands back and says, okay, listen, we're going to let this thing run without us. We're going to pull away. The economy will run on its own now. We've got it. We've done our job. Everybody is mostly working again and everything. We can step back and see if it'll run on its own. It's not going to. It's become a zombie, like a zombie corporation. It's a zombie economy. It's a command economy. And what'll happen is it'll run just for a little while, and then all of a sudden it'll conk out. Almost like a car that can't idle, you take it's all right. You get your foot down on the accelerator, roar in the engine, and yeah, it's going. But you say, okay, and you shut the door and you get out of the car and pick your foot off the accelerator, and it runs for about 3 seconds, and then it conks out. That's what the economy's going to do. You can't pull this life support away and expect it to stay running. It'll run for just a little bit because it's got momentum. And that's where we're at in this right now. The Fed and everybody, they're all trying to, will this zombie economy run on its own now? Can we pull away support? No, it's going to crash. It's become a zombie economy. It's become, the whole economy, the whole world is like a zombie economy. It's like a command economy. And now the central banks has to continue the support or the whole thing will come down. Let's take a look now at silver price today. It, this is not going to end until it ends. And what I'm talking about is talking about Basel III and the slow adjustment that's being made now over from a paper market. Used to be gold and silver were all just controlled by the paper asset that it was a derivative of the real product. And that's what actually controlled the price. It's changing now over where it's not going to be the paper that controls the price. It's going to be the actual physical that controls the price. And that adjustment, that change, is going to take about a year. And during that time, there's going to be big fluctuations in price and stuff, but at the end of that, look to the end of the year. At the end of the year, what we're going to see is gold and silver break free and become a free market again, because it's not going to be controlled by the price, controlled by the paper anymore. So you're going to have to wait about a year for that to be fully enacted, fully and come into effect. But during this next year, expect volatility, especially in this first 6 months here, leading up to January, because of Basel III. Expect volatility, and that's what we've seen this morning. But now it's bouncing back. So we got a silver price of $26.10, and it's down 2 cents on the day. Let's take a look at gold. Gold is actually not down at all. It's up $8.20. It's at 1804 right now for gold. Let's take a look at cryptocurrencies today. 1,473 billion, so they're doing good. Because yesterday it was like 1430. Today it's 1473. So it is up today at 34,664 for Bitcoin. So that extra billions of dollars looks like a lot of it's been absorbed in the altcoins. Now that's a good sign. When we see them buying heavy into the altcoins and Bitcoin not moving much, that's a good sign that the market is starting to turn bullish again in the cryptocurrency space. So that's cryptocurrencies today. Let's take a look now at the Dow Jones. The Dow Jones is off 39 points. Now, it was off quite a bit more. It's starting to bounce back. 34,538 now. It's been bouncing back in the hour or two. It might actually end on the plus side today. Let's flip the page now. It's down only 14 points. So it might end up on the plus side today. It might even end up like 80 points up or something like that today. It wouldn't surprise me a bit. Let's take a look now at crude oil, 71.20. It's down $2.17. I'm going to tell you guys, just been through a little bit of a rumbling in the markets, almost like a little earthquake. But I tend to think it'll go away in a few days. But this was a warning. This is a warning, and why I say that is the way I see bonds moving right now. This is a warning of a bigger crash that's coming in our future. How long will it hold off? I don't know. Will it hold off into next year? Very possibly. But it very possibly could happen before the end of this year. There's a market crash in the making. And it's because ample liquidity was poured into the system. Massive amounts of liquidity to support us through the COVID crisis. And what they did was they changed everything into a command economy now. There's no real markets anymore. And now they're thinking that this will run on its own. It won't. Once you go into these programs, it's like the Roach Motel. Once you start quantitative easing, you can never quit. You're never getting out of these programs. Once you start UBI, you can never quit. Once you start with this, it's like a trap. It is like addiction. An awful lot of substances and stuff like that, addictions and things like that. Once you start, you ain't gonna quit. And that's the way with this monetary addiction that they have to fiscal and monetary stimulus. They can't quit. And what they're doing right now is they're trying to back off. and they're going to make a crash, and then they're going to have to come in strong on the other side of the crash to bring things just back to normal again. That's when confidence is going to be lost. It's going to be over. It's going to be game over, guys. Game over. Game over's coming. And within the next year, and I think I'm giving myself plenty of room there when I'm saying a year. I think it's going to happen sooner. I think we'd be lucky if we get through the end of this year and into next year, and the pressure's building every single day. The pressure's building for this monster of a crash of the system. Let's take a look now at we're at crude oil down $2.17. Let's take a look at the MOVE index, starting to go up now, 56.55. Bonds and rates. Now this is the big story of the day is how these bond yields have been falling. The 10-year was down to 1.30. 1.3 it was down to this morning. Now it's at 1.318. It's down 5.2 basis points on the day so far. And the U.S. 30 years is down below 2% at 1.93. It's down 6.6 basis points. These are some major moves in bonds been made over the last few days. And normally this is rocket fuel for gold. When you get a U.S. Treasury bond down around 10-year down around 1.3%, normally that's rocket fuel for gold. But right now it's not. Gold's not taking off that much. But see, why that, I'll explain to you real quick why that's rocket fuel for gold. Is that's a high price treasury. You get a 10-year, it's only yielding 1.3%. There's like a little war between gold and treasuries, They look at the treasury market as a safe haven asset. They look at gold as a safe haven asset. So they're in competition between the two. But if the treasury yield's not paying nothing, then they say, okay, we'll grab the gold instead. Rather than the treasury yield. For the treasury yield to be more attractive to investors, it has to have a yield. And when you get down to 1.3% for a 10-year, that's not much yield. Okay, let's take a look now at the dollar index. Actually, with the way inflation is right now, that's a negative yielding bond. 1.3% per year. Inflation's much higher than that. That means you're guaranteed to lose money. And gold's job through history, even though it doesn't have it bear a yield, gold's job through history is to keep up with inflation. So gold will rise to the price of inflation. So if inflation right now is at 6%, you're going to see gold go up 6% per year. So that means you're getting 6%. The U.S. Treasury is only yielding 1.3. Even though it has a yield and gold doesn't have any yield, that yield is lower than what gold's going to be because gold's going to keep up with inflation. Do you really believe that gold's not going to keep up with inflation when it has over the last 300-400 years? You can go back and you can see gold keeps up with inflation exactly. It's an inflation hedge. So inflation right now, they admit it's like 5% or whatever, or 6%. It's probably more like 12% or 15%. So gold's going to keep up with that. Really, I tell you the honest to goodness truth, gold is probably in the next 3 or 4 years is gonna keep directly up, and if there's a hyperinflation, gold will keep up with that too. And there's no upper limit. I mean, if the dollar becomes only worth a penny, gold could go up 100 times to keep up with it. It's going to keep up your purchasing power. It's going to keep your purchasing power through the hyperinflation. So, whatever wealth you have, and you put that wealth in the gold now, you'll maintain that wealth through the hyperinflation. But if you're in dollars, the dollars might become worth a penny or less. So where do you want to be? Okay, let's take a look now at let's see, the dollar index. Well, that's the last one on our show. It's at 92.75, and yes, the dollar's going up. That's because into a crash, if we have a crash, the dollar's going to go way up in value. It could, the U.S. dollar index during a mega crash could go up as high as 120, because all of the countries are going to be affected on Earth if we have a mega crash, a big, massive deflationary crash, and they're all going to run into dollars because dollar is the best one. No, not because the dollar's good. They're going to run into the dollar only because it's the best one out there for safety. We're already seeing that nervousness, this little shaking of the ground we're having right now. They're nervous out there, and they're running into dollars. Dollar's up today, 92.75. You get a major crash, you could go up to 120 on the U.S. dollar index. But then what would happen next after the Fed comes out and says, well, we're going to fix all this? This is a normal thing they always do. Then the dollar will crash. Thank you guys for listening. Like and subscribe, and we'll catch you guys in the very next show. Bye-bye.